Hey guys, welcome back to another video. Today I'll be exploring exchange traded funds, or as they're more commonly known as ETFs. To start, let's define what an ETF is. An exchange traded fund is a collection of securities such as stocks that track an underlying index. So think of it as a number of tradable securities such as stock in Amazon, Facebook, and Apple, all packaged into one tradable asset on a market exchange, such as the NASDAQ or the Australian Securities Exchange. So it's simply a whole bunch of assets that are packaged into one tradable security that can then be bought and sold on a market exchange. And you may be thinking this sounds like a managed fund, but one of the main differences is that ETFs are listed on an exchange, whereas managed funds are not. So you don't actually buy into a managed fund over an exchange, whereas if you want to buy into the exchange traded fund, you need to purchase it over an exchange. Now moving on to why you should take notice of ETFs. So ETFs have gained a lot of traction over the recent years for a number of reasons that we'll explore. So ETFs typically offer lower expense ratios in comparison to managed funds. You can expect a majority of ETFs to have an expense ratio of less than 1% per annum, with some of the larger ETFs only costing 0.1%. So extraordinarily low cost to once you've bought into these funds, the fees associated with the ongoing costs are very low, which is very important when it comes to investing because it can eat into your overall returns, and as we'll explore later with compound interest, it can have a significant impact over the long term on your overall output. So additionally, you can save a significant amount on brokerage costs as you're able to gain exposure to potentially hundreds of companies with a single trade. Because again, they're all packaged up into one tradable security. This is opposed to buying stock individually, which could result in brokerage fees in the thousands of dollars. Because traditionally, you would, if you wanted to get similar levels of diversification that an ETF provides, you would need to purchase each of those stocks individually. And by executing each trade individually, you'll be paying brokerage on each of those trades, which would amount to a large amount of money. So another benefit of ETFs is the high level of diversification that you can achieve by buying them. So traditionally, when buying stocks, you would buy an individual company, and therefore you'd be exposed to the fluctuations associated with that company. So if that stock was to tank by 10%, you'd take the full 10% hit. Whereas with an ETF, say for example, if it was tracking an index that tracked the top 300 companies within Australia, if one of the companies within the Australian index dropped by 10%, your total exposure to that company would be significantly less because you've diversified across 300 companies. And on that particular day, if the rest of the stock market was trending upwards, you wouldn't even see a loss associated with your portfolio. So this is quite an attractive feature to investors because they don't get hit as hard in the event that a particular one or two companies fall down, but rather follow the market and the overall economy. So a few things to note when it comes to ETFs. Firstly, ETFs trade at something called their net asset value, or as it's more commonly known as NAV, which means that an ETF price is determined by the value of its underlying assets. Also, ETFs can contain all types of investments, not just stocks, so commodities or bonds. So for commodities, you can trade gold, which is a lot of people like to jump on gold ETFs, especially when they believe that it's going to be a bear market or a potential recession. And also bonds, which are like fixed income based ETFs. Also, ETFs can provide a simple and easy way to gain exposure to international markets. So, for example, there are a number of ETFs on the Australian Securities Exchange that hold equities overseas. Therefore, it allows you to buy international equities through a single trade on your local exchange. So, for this example, I'm from Australia, so it allows you to buy on the Australian Securities Exchange, and then but in doing so, you have international exposure to other countries such as the United States, and therefore able to reap the rewards of those economies without having to trade on their exchanges. If you buy into an ETF that's tracking a market, such as the S&P 500 in the States, or here in Australia, the ASX 200 or 300, it will not outperform the market, and it also will not underperform the market. It will literally track the market because the assets that make up the ETF is based on the index. So there's benefits and pros and cons that come with that. Firstly, obviously, you're not going to make exuberant amounts of money by doing this, but it's a long-term investment strategy that does pay off if you are disciplined enough to hold the asset for a considerable amount of time. But there's also pros to that, because in the sense, the diversification means in the event that a few of the companies go belly up in the top 200, you've got limited exposure to just those. You're not so concentrated on just those companies, but rather have that level of diversification across the top 200, and therefore the downturn in your portfolio will be minimized. When it comes to purchasing ETFs, there are a number of providers such as Vanguard, BlackRock, State Street, Global Advisors, and BetaShares. A lot of them have crossover and interlapping between the products that they offer, and will vary slightly. Like, for example, here in Australia, in Vanguard and BetaShares both offer an index fund that tracks the Australian top 200 and top 300 companies. So I think the BetaShares one tracks the top 200 companies, whereas this Vanguard one tracks the top 300 Australian companies. So quite similar, and the overall performance of those ETFs are very similar. So you can see considerable overlap in the products that are being offered. So something to look out for when comparing ETF products is the management expense ratio, which it represents the cost of holding that asset over the period of time. So when comparing them, you should look for the one that has a lower MER, and there's other variables to take into consideration, but that's probably the main one. Now, ETFs do have an ongoing per annum cost associated with them, and we express these costs in something called a management expense ratio, or MER. And these MERs differ based on the ETF product within a particular provider and across providers. So certain ETF products are cheaper than others. Usually, from what I've seen and researched, the more funds under management, or the bigger the ETF, the lower the MER. That's because of economies of scale. So as they scale up the ETF, they can afford to charge less of a percentage, because the overall income generated is larger because the assets under management is considerably bigger. I think when looking at ETFs and investing, of course, it depends on the ETF that you look at, because there are a lot of ETF products on the market now that do all sorts of things. Like, you can get exposure to emerging markets, obviously the US market, Europe, those sort of things. Is you want to, again, hold these assets for a period of time, probably around 10 years or greater if possible, because then it allows you to really just reap the rewards of compound interest, and I guess long-term exposure minimizes the variance in your returns. If we just have a look at Vanguard's website here, we can see that they've got this is their total share market index of the US. So Vanguard is one of the providers of ETFs that I mentioned before, and this is just their product page that I've reached. So if we just have a look at some of the information we've been provided here, we can see that the current trading price is $151.59 USD, and the management fee on this particular ETF is extraordinarily low at 0.03%. And that is also, we call that 3 basis points. So 0.03% is also referred to as 3 basis points. It also just gives you an overview of what the investment objective is, and in this instance, it aims to track the total market shares index, as you can see here, and providing investors with exposure to a broadly diversified collection of securities that in the aggregate approximates the full index in terms of key characteristics. There's more information around the fund overview, risk, and that sort of thing. And what we're interested in here is the returns. So we can see that since its inception, it's returned 15.81, which is relatively similar to its 10-year performance, which is very impressive relative to other asset classes within this time frame. So 15.95% is quite a strong return. Also, looking down here, we've got some more information around its dividends, because ETF products do pay dividends. They wrap up all the companies that they own that pay dividends, and then distribute that as a payment as a whole to their investors. Other key figures that you can look into if you're interested. Also, this is an important one. You can see the top 10 holdings of the ETF. As we can see here, we've got 10 these are the top 10 relative to this particular ETF. and we've got the big tech companies in here. And also should note that for this particular ETF, the top 10 holdings make up 18.9% of the total ETF's value. And then for other ETFs, not so much this one, but it's important to check out the market allocation exposure geographically. So here we can see that because this one's tracking the US stock market, it's 100% in the United States. Okay, so if we just have a look at a compound interest calculator to emphasize the importance of fees and how ETFs have gained traction because of their low fees relative to managed funds, we can see the difference in performance because of the fee reduction with ETF products. So looking here, if our initial deposit was say $100,000, for this particular example, we'll leave the regular deposit at 0. The compound frequency annually, and let's bump this up to say 30 years, and we'll also adjust the interest rate to something like 9.5. So this will represent the the ETF's return. So if we click that, we can see if we had $100,000 to deposit and we left that for 30 years, we could expect, based on the current interest rate given, $1.5 million at the end of that 30 years if the markets achieve that 9.5% on average return, which historically they have been able to. But if we look at, say, a managed fund and we give them a similar interest rate, say 9.5, they also earn 9.5, which is quite generous considering 8 out of 10 fund managers fail to outperform ETF-based products such as VTS. So in giving them the same interest rate, we're giving them a bit of leeway here, but also for actively managed funds, they usually charge around 1% fees, which is 100 basis points. So relative to the US stock market here, we can see that that's 0.03, which is 3 basis points. 1% is 100 basis points. So if we take pretty much a whole percent off this, for argument's sake, 8.5, we can see that it was 1.522 for the ETF-based product. But if we move over to the managed fund, which we need to subtract 1% because that's the fees they're going to be charging on the actual fund, we can see the difference is quite large at around $400,000 or just under $400,000. And then that can be multiplied if we hold on to the asset for longer. So here we can see for 50 years, it would grow to 5.9 million. If we were to hold the managed fund, and then if we wanted to go back to the ETF-based product at 9.5, it goes to 9 million. So over a long period of time, you can see the major effect that it has on the overall interest. Not the overall interest. Well, actually, the overall interest return, because you are subtracting the fees, but the overall return is significantly different by just removing that 1%, and that's why fees associated with ETFs are so important relative to managed funds. Thanks so much for watching, guys. Hopefully this has given you a bit of a basis for what ETFs are and what they have to offer. I encourage you to do some more research on your own to explore ETFs further if it's something that you're interested in buying or investing into. If you have any questions or concerns, please drop a comment down below and I'll do my best to get back to you. Cheers.